If you're looking to buy Matterport stock, then please keep watching this video because we're going to look at the company's recent news, how's the market treating it, and what are the technicals telling us, and finally and most importantly, what is the best trading approach. As the market is very volatile at the moment, we should always be careful about which stocks we take on, as well as their individual timing, risks, and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Matterport has been going through a stabilizing phase over the past few weeks, staying around the $4 level. The appeal of Matterport is the products that it delivers, which can potentially change the way people operate in many sectors, like real estate and content creation. But if we're honest with ourselves, Matterport has been benefiting from favorable market conditions, which in turn became a self-fulfilling prophecy by attracting retail traders in and push the price levels even higher. What happened afterwards over the next 12 months has been a classic profit-taking, coupled with the change in the collective mindset. Investors no longer wish to pour capital into the tech sector, and the uncertainties around the world, along with the increase of central bank rates, have completely modified the way people see risks in different investments. With that being said, the recent trading session saw Matterport getting a lot of support in its current price level, and I would say that this phenomenon is certainly not unique to Matterport alone. Many tech stocks have been showing signs that the sell-off has lasted for long enough and that there would be at least a pause for the moment and possibly a rebound from there. Now, let's also take a look at the technicals of Matterport. The trading volume has recently been around 1.2 million shares versus an average volume of 5.6 million shares. Over the previous 52-week period, its price fluctuated between $3.51 and $37.60. The volume of shares traded tells us how many shares are being bought and sold at any given moment in the market and if there's enough liquidity to support a trading strategy. If the float is very thin, it would be very easy to influence and push the stock price around, but low liquidity could also mean that the demand is very limited. When we compare the current volume against the average volume, there might also be a possibility for trend reversal or breakthrough if the difference is very large. So for example, if the stock were to break through, the current volume would significantly increase compared to the average volume. The market cap of Matterport is currently around $1.2 billion versus an enterprise value of around $2.1 billion. To put simply, the market cap is the fair market value the company has based on the current market sentiment, the company's reputations, and other macroeconomic factors, whereas the enterprise value is usually the cost that a company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies might be the intangibles, which means that they might not be items or stocks that a company can use to generate more income, but they're usually pledges for a better future, such as with intellectual properties, brands, and the existence of great leaders. So for startups, most of their valuations were based on those intangibles, and if they were valued in more favorable market conditions, what this means is that there could be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below its book value, and it doesn't mean that a company itself is necessarily undervalued. It's also possible that it was overvalued in the first place and only deflating itself back to somewhere normal. As we compare the current price to the historical price fluctuations, the stock is 16% higher than the 1-month low, 16% higher than the 12-week low, and 16% higher than the 52-week low. On the options market, often giving us a hint about the market sentiment on where the stock price could go next, the implied volatility is 101% versus a historical volatility of 83%. The put-call volume ratio is currently around 0.18, and it is normal for many stocks to have a higher put volume than what they truly deserve, as many institutional investors would hedge their long positions by buying put options. The most recent volume of options traded has been 300 contracts within a day versus the 30-day average of 3.5 thousand. Regarding the open interest, the most recent volume of open interest has been 131,000 contracts versus the 30-day average of 193,000 contracts. The option contracts are tools allowing traders to hedge their risks, increase their exposure with limited downside, or as an additional revenue stream. They are derivative contracts based on the underlying security, and they give traders the possibility to buy or sell the security at a predetermined strike price, helping limiting the potential downside. The put options allow selling at the strike price, usually chosen if there's an anticipated downturn, and the call options allow buying at the strike price, usually chosen for anticipated bullish runs. In terms of its shareholder structure, institutional shareholders own 8% of its outstanding shares, the biggest shareholders including Fidelity, Vanguard, and ARC Autonomous. Usually, it's best to see some institutional participation when holding a stock for the long term, because it does offer a layer of stability and a token of reliability in the medium to long term. It means that the market is confident it will deliver value in the long term, which is an important factor to consider for investors. I personally consider the minimum threshold to be around 25 to 30% for institutional ownership, although there are many exceptions to this rule, as there will always be great companies, mostly owned by retail traders as well. Let's also take a look at the short interest of the stock, which is the number of positions that will profit from falling stock price. The way it works is that short positions will borrow the shares from the broker, sell them in the market, and buy them back later, profiting from the difference between the two timings. If there are significant short interest, usually above 25 to 30%, there could be potential for a short squeeze, whereby traders could buy the stock up, forcing those with short positions to redeem themselves, acting as a buy for the price action. This is what people refer to as a short squeeze, and it became popular in recent times, with successful short squeezes such as GameStop and AMC. The short interest is currently about 16% of the total float, with 45% of them outside of the public exchanges. So usually if there's more than 15% of short volume, there could be a potential for a short squeeze. So I would say that, keep an eye out for this, as even if we don't have a short squeeze per se, we're going to have a lot of positions that would have to redeem at some point. So this will be like additional demand for the stock later on. My recommendation is to buy Matterport now and to leave about half the allocation to dollar average down later over the next 12 months. I would recommend to commit between 3 to 5% of your portfolio, and would also recommend to split the allocation in batches of 20% at a time so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.